This is Benzinga Live with Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have a
breaking news. What is up, everyone? Happy Monday. Welcome back to another episode of Benzinga Live. I'm your host, producer AB, Aaron Bree. Hope everyone had a great weekend. Good day so far, at least in the markets. S&P 500 at this point up more than 2%. I don't even know the last day I've been able to say that. So nice to see. To be determined, TBD, if this is just another little bear market rally or if this is something to really sink our teeth into and pay attention. I'm not ready to make any calls yet about if this is the bottom or not, but I'd be happy if it is. Quick rundown for the show today. Here in a few minutes, I will be joined by Nugent, the co-founder and CEO of Noggin, ticker NOGN. A little bit later in the show, we will be welcoming Interactive Brokers on the show to talk about a new cool product that the platform is offering, something that I personally, as I'm someone who dabbles in more degenerate investing, really excited about this product from Interactive Brokers, so that should be a fun conversation. We are going to talk, of course, about the Credit Suisse news. We will talk about what to look forward to this week. We've got a big week on the economic calendar, jobs data coming out throughout the week that will be very, if you guys remember, we got a good jobs report in the sense that we added more jobs than expected, but of course the market went down on that because that means then the Fed has more power to keep tightening because they say, oh, look how strong the labor market is. So just like that, this week, if we get a jobs report that shows that more jobs were lost than expected or unemployment went up, then that could be good news for the market. That's where we're at right now. Unfortunately, I would like the market to be celebrating good economic news, right? We got a GDP revision last week that went from, what was this? I mean, this was crazy. I think it's so funny too, because, people here, even on the show, I've gotten a lot of criticism from people in the chat basically saying, there's a lot of economic indicators. There have been a lot of economic indicators that show things haven't been great, but I haven't really been buying into. I was like, call it if you want. If you want to call this a recession, sure, but if you can't equate what we've seen over the past 6 months to 07 or 08 or really any other real recession that we've seen. So people are in the chat are always like, come on, AB, we're in a recession. What are you talking about? And I'm saying, sure, if you want to call it that, fine, tomato, tomato. But this was from the Atlanta Fed GDP Now. And we'll talk about more of this after our first interview. But big data upgrade. GDP Now print at 2.43%, up from 0.27%. So for all the people that, want to say how bad the economy is, huge recession right now, I can't think of another recession where we've added jobs and GDP is positive. So that cuts across that notion a little bit. Not really great news for the market, because that just means, again, that the Fed can sit there and say, see, things are too hot. We do need to keep tightening until things settle down a little bit. But all right, that's enough macro talk. Let's go ahead and gear up for our first interview of the day. Again, Nugent, the CEO and co-founder of Noggin, a cool technology company. We're going to talk to him a little bit more about what the company does, because there seems to be sometimes some confusion. Not a SaaS company, but a commerce as a service company. Let's go ahead and give Jan our very special intro and bring him on the show. Jan Nugent, the co-founder and CEO of Noggin. How are you doing today?
How's it going, man? Good to see you. Thanks for having me.
Of course. Thanks for taking time out of your busy Monday to join us. So before we hop in, I want to hear a brief overview from you of what the company does. I don't know if I did it. Tell me if I did a fair job of that introduction. I know sometimes there's some confusion out there about, is it a SaaS company? Is it this? Is it that? So I want to hear it straight from the horse's mouth. What does the company do?
Yeah, no, I appreciate it. So what Noggin has done is basically enterprise commerce is extremely complicated in the SaaS world, because you buy one commerce piece of technology, you usually pay an Accenture to integrate 50 other pieces. and now you're managing sort of a 50 piece of technology infrastructure. What we've really done is simplified enterprise commerce, where we've built all 50 pieces into a single platform. The brand still has complete control, but instead of focusing on technology, they can focus on the customer, the merchandising, the brand, all the things that kind of drive value for them.
Yeah, so we're looking at this site right now. I can see some of the partners, some of the clients right here, some big names. So and I'm kind of sometimes the slow down guy, where I like to break things down, slow it down to make sure I understand it properly, because sometimes it doesn't happen that quickly for me all the time. So take a company like Brookstone, for example.
Yep.
Is it as simple as essentially Noggin does the technology behind Brookstone's online store? So like you said, they don't have to worry about any of that stuff, or how exactly does Brookstone use Noggin in their day-to-day?
Yeah, so think about what Shopify has done for like 1.6 million small merchants, right? Is made a pretty simple platform where they can kind of just drive. And then a Nike, for example, might have 100 developers and tens of millions of dollars to sort of build and maintain a really complex infrastructure. There's companies like Brookstone where they need that Nike level of infrastructure, but they don't have like a big IT department. They don't have a ton of cash. They don't have a bunch of data scientists to kind of navigate the future of e-commerce. So we do that for them. So we've just created a full stack platform. The R&D is included. And we're just trying to kind of make commerce like the AWS of commerce, where you can just kind of plug in and leverage it. So at Brookstone, as an example, yes, we handle all their technology. Theirs happens to be a really complicated environment. And then in their case, we also have technology that drives traffic, and we have technology that also handles like the fulfillment and shipping. So they leverage those pieces as well, because Brookstone in particular handles so many different types of products. They can use the technology to plug into a bunch of different suppliers and provide kind of a marketplace to the consumer.
Yeah, I've long said, Brookstone is my favorite place to go if I need to buy a foot massager and a speaker on the same day.
Right? Remember Ryan Gosling with all the massage chairs back in the what was that movie?
Oh, I'm not quite sure.
Crazy Stupid Love. I think Crazy Stupid Love.
Yeah. So basically, with these companies I'm seeing here, I'll pull the screen back up. You kind of got the sweet spot for Noggin in terms of partners are these bigger companies, right? Because they need to be able to afford or have a need to really beef up their IT and their commerce. But not necessarily the biggest, like the Nikes, the Apples, the Microsofts. They probably have the infrastructure to build their own platforms, you're saying?
Yeah, exactly. Like we would call it the mid-market. Nike is billions of dollars and maybe even $1 billion online. Our brands are in that 5 to 50 online, and maybe they're $50 to $500 million companies. And the single biggest thread for them, right, is that they tend to not be technology first, but they still have to provide world-class e-commerce. And so for us, we kind of demystify it. They can just plug in. And the other part is there's not a lot of scale, right? Some of the things that Amazon and Apple and Nike are pushing, a $10 million store can't keep up with that kind of sophistication. Whereas because we have many clients, we can build kind of that kick-ass 2 years down the road stuff and make it easy to digest.
Yeah, because those mid-market, like you said, like those are the ones that have the most to benefit from outsourcing something like this, right? Some of these companies, like, it wouldn't make sense financially to go spend millions of dollars hiring developers and coders to build this out when you can outsource it for probably a lot cheaper. By Noggin to have like experts, like you guys know what you're doing, instead of having these people try to come up with their own platform, and it might be great, might not be great.
Yeah, and the cool thing is the platform's built in such a way that they have all the control as if they were doing it themselves. They can log in, and there's not a single thing that they can't do without calling us if they don't want to. And so we've kind of made it for the people who want full independence, and it's just outsourcing of the technology and the R&D, then they can do that. If it's other people who want a little more support, we can kind of provide that as well.
Got it. So Noggin went public via SPAC, correct?
Correct.
and that was in August 20, so a couple months ago. There's been a lot of, companies that have kind of, that they were supposed to SPAC, decided not to. Was there any, what was the process there deciding to go through with the deal at that time, essentially?
Yeah, I think what I saw was there were many companies who didn't meet the new rigors of what the market was putting on a SPAC to get out. And then they positioned as they chose not to, but the truth is they couldn't. For us, because we're a little bit more mature, we've been around, we did $68 million last year. Our growth is strong for the most part. We've built the company with only 7 million of primary capital. So it was, kind of a solid kind of cash flowing reinvestment business. We sort of met the rigors of getting out. I think what happened since then, that's a little bit of a challenge, but the reality is we still have, kind of the business and the strategy. And then we're just kind of hoping that the market, stabilizes a little bit and we start to be seen for the company that we are rather than just yet another SPAC.
Yeah, and I think as we've seen, the SPAC market kind of develop over the last 2 years, in the last 6 months or so, since we've had the market downturn, you've had these companies that were planning to go public via SPAC and they decided not to. To me, the ones that have gone through with it, like you said, like you need to be kind of a more legitimate company. You need to have certain financial at this point to go through with it. And I think, at least for me as someone just looking at this stuff, that would give me more of confidence as an investor saying, okay, they went through with their plan. Instead, if I saw a company that was supposed to go public via SPAC and they bailed out because the market downturn, it's like, all right, then that would look to me as maybe they weren't really as far along as they were, selling themselves to be. And then now when the market got a little tougher, they're out. So I think that's a good sign to me as someone who's looking on the outside.
Yeah, we're hoping to be the class of 2000. I think that was Google. After the washout of 99, the companies that went out in 2000, there wasn't a lot of fanfare. So we're just, we're going to keep our head down. We're going to keep helping clients, keep the growth of the revenue. I think for us, because it was just a moment of time where there was a capital raise and getting the visibility that comes from public, because for us, we've been sort of a best kept secret. And to get the visibility to be considered, kind of one of the 3 or 4 major players, that has a lot of benefit to us. And we don't need the market to be great, for a couple of years because we're, just chopping wood and carrying water.
Yeah. So I see in the chat, Christoph Marin's asking some good questions. Sounds like he might be an investor or something. What kind of revenue are we talking about per enterprise client? What's the CAC? What's the market size? Give us some meat to noodle and research, please. Sounds like you might be a prospective investor.
Yeah, so the market size is probably ridiculously large. I mean, it's probably $1 trillion because if you look at the mid-market across all the core verticals that need e-commerce, consumer products, beauty, health and wellness, apparel, emerging verticals like, kind of metaverse stuff. And you just look at like how much they can sell online and we would take a percentage. It's a major market. The thing about Noggin having been a best kept secret is that we've had quite large average deal size. Our average deal size over the last kind of 18 months has probably been $6 million ARR. So our stores, we've been kind of handling the upper end of the mid-market. Part of the Noggin strategy of going public is we are using some of the capital to get much more external. And we've done a lot with the technology to open it up where we'll support a much bigger chunk of the market and do a lot more deals. So we have a lot of greenfield because, we can scale at deals that are $400,000 a year. And primarily because of the way we were funded, we were handling more like $6 million deals. So in terms of like a CAC to LTV right now, it's ridiculously high because our external marketing spend has been so low. And we did probably $45 million in bookings last year with, 2 or 3 salespeople and not being very niche because we're known in a certain area where we provide a lot of value. And so now it's going to be opening up that pipe, which will bring down the CAC a little bit, but it'll generate, sort of a much bigger footprint within the market.
Yeah. What do you think is the biggest thing that, like, you know, companies that use Noggin for their commerce or IT solutions, what do you think is the biggest thing they come back to and are you know, see like the biggest benefit? Is it the fact that, you know, the actual it's seamless for consumers to buy things on the platform? Is it that the data being offered is amazing for companies to be able to do those analytics and say, okay, we were selling so much of this product last month? What's to you know, the biggest selling point?
Yeah, to me, the biggest selling point is it's a little bit like Formula One auto racing, where the best car that won the championship last year, if they don't come up with a whole new car, it'll come in last place the next year. So the trajectory of the consumer behavior that's being driven by like Amazon is so steep that you get these people who spend, even on the Shopify, like 300 grand, 200 grand, creating a new platform. Well, year two, it's dragging. You know, it's not growing at the same rate. They're giving away too much free shipping. So for us, the biggest benefit for them is they just know that our clients demand performance. And so we're reinvesting into that platform across all the elements, whether it's to grow the top line, increase the conversion, cut the traffic. You know, this whole iOS thing that happened, the individuals, they were toast because they really couldn't do anything about it. Whereas with us, because we have strategic partnerships with Google and Meta, we could do server-side connections and actually address some of the changes so that we weren't hit so bad on traffic across our platform. Or, you know, on the shipping side, we have algorithms that maybe don't have to provide free shipping as much. So I think it's really just they don't have to worry about the innovation, and they know it's a platform that's trying to drive healthy growth year in and year out.
Yeah, so essentially, to make sure I'm understanding correctly, you're saying to you the biggest selling point is the fact that you guys have this infrastructure to be able to be constantly updating the platform, staying up to speed, as opposed to the companies that might spend all these resources building their platform, their e-commerce platform, and then in 2 years' time, it's completely antiquated.
Exactly. And the hard part for them, right, is they don't necessarily have the dollars to keep up with the R&D every year. And even if they do, it gets overwhelming. Like, what's the right stuff? So you're seeing a lot of shelfware out there where maybe they bought some new things and they paid a systems integrator to integrate it, but maybe it's not actually driving an ROI. Whereas with us, because we can test everything, the stuff that we implement tends to really perform.
Yeah. Let's see if we've got any questions in the checks. We've only got a few more minutes left. So yeah, and something I'm curious about in the kind of, let's say, medium to or short to medium term, what are you looking forward to, or what should investors be looking forward to? Is it as simple as like adding more clients, more partners to grow revenue? Or are there other things in the pipeline?
Yeah, for sure. I think there's a couple things. I think one, because the SPAC process took a little bit long, and during COVID, there was a little bit of overhang from the supply chain that hurt us. You know, I think they get to look forward to that's cleaned up. You know, if you look at the first 2 quarters, we were negatively affected by some cleanup from the supply chain. So that's pretty much behind us. So there's that. And then going forward, yeah, now that we've opened up the pipe, like we announced, I think, 8 new brands that have come onto the platform over like the last 6 weeks. And that's exciting too, because they're in consumer products, which is a really big emerging vertical where they're a little bit behind in terms of getting online. So there's exciting companies that can drive a lot of volume that are moving onto the platform. You know, and then we have a big release in February that's a really sort of self-automated commerce platform where it'll automatically segment customers. It'll automatically serve these customers different content based on their tastes and preferences. And ideally, it'll increase performance for the merchants and make the consumers a little bit happier. So that's a big step where for a lot of people, that's really hard.
Yeah, no, I love to see. I mean, if you're investing in a company, I mean, I know Noggin isn't technically a SaaS, more a commerce as a service, but if you're investing in a company that is doing something like that, where you're kind of outsourcing, or you're allowing companies to outsource these products and services, you want, like you said, a company to be able to be up to date and constantly updating. Christopher Marin in the chat's asking, who would you say your biggest competitors are? Are there other people outsourcing, you know, e-commerce solutions for companies?
Yeah, so it's a good question. I think they would call it the infrastructure as a service space is definitely you're seeing money flowing into there. So you're seeing some people kind of take little offshoots of what that term is. But in terms of anybody who's been in the market for a long time, we're really kind of alone right now with good white space. For us, we view it more like our biggest competitor is no decision. So let's just say you have somebody who went on Shopify, maybe they've grown to the point where maybe they are looking at having to spend on enterprise, or they could plug in a Noggin. If they choose to do nothing, right, just stick with status quo, that's a deal that doesn't get done today, but maybe it gets done in the future. So it definitely appears that there's a lot of funding in the space, but nobody who's really come up on our radar that's a threat.
Yeah. That's yeah, I mean, always, as if you're an investor or a potential investor, well, you know, you always want to be cognizant of who the competitors are, see how the rest of the industry is doing. So Jan, did we get through? Did you want to give any more clarifications on exactly how to you know, describe Noggin, what you guys do?
You know, I think for us, it's just if there are brands or merchants or retailers that need really sophisticated commerce, but it's difficult. With us, it starts with moving onto our platform, and it's kind of the best of both worlds, where you get all the control as if you built it and managed it, but you just plug into it. And then for those of them who need more sophisticated services, and really for us, it's like, how do you drive traffic, or how do you deliver better and cheaper, right? And then lastly, if they're a little bit overwhelmed by the future and they need some experts, you know, we've got kind of like our Noggin nerds, you know, like the Genius Bar, to kind of help navigate. And it's a la carte. You start with the tech because it's just a faster car. And then from there, you know, people can scale up with more support, or they can scale back if they want to be more independent. And it's global.
Yeah, I remember something else I was going to ask you on. Are there any specific, because it seems like there's a wide range of industries that the companies you're working with, whatever, you know, what industry they're in, right? We mentioned Brookstone, but then you've got some more. Are there any particular industries that you've found, you know, you guys do really well with? Like, I know you mentioned beauty and cosmetics. That seems like it'd be a good fit.
Yeah, it started with apparel and accessories because that's the most complicated. Like, if you think about it, they have a ton of SKUs. There's new seasons coming in 4 times a year. They basically have to turn over almost the whole brand once a quarter. So because we're enterprise class and easy, those brands really needed sophistication, but maybe weren't that sophisticated, you know, in terms of technology. And because of that, we basically are very referenceable into other industries, because they kind of, one, look at, wow, that's complicated, and two, that vertical does a really good job with brands. So you must really understand how to support a brand with tools. And then as we moved into consumer products, a big piece of us is we have a subscription engine, you know, this holy grail of like, hey, can I get you to order the toilet paper to arrive, you know, every 2 weeks, instead of having to come back to the site to order the toilet paper, or the beauty cream, you know, or whatever those things are, that it's been difficult to kind of have subscription engines, you know. And then metaverse, we come from digital roots. So we're good at digitally downloading things and having them be certified, because we came from software originally. And so as that starts to become more commercially viable, we're pretty well suited there as well. I think the only areas that really you maybe don't need us is if you're really small and it's very simple, you know, you're good with Shopify. Or if it's a really low cost thing, like it's $12, you know, and you really need something that's much more simple, then you probably don't need us as well.
Yeah, no, I love that. And personally, I've been, I think, as far as investments go, because people for the longest time, really since 2000, you know, really people have been, for largely in the investing world, looking for the next big tech company, the next Apple, whatever. But a lot of these, you know, kind of companies in the apparel or beauty and cosmetics space, if you look at Lululemon stock or Ulta or You know, a lot of these companies have been doing really, really well. So I personally am trying to learn more about some of these apparel and beauty and cosmetic industries, because just my hunch is that as far as investments in the stocks go, is that people kind of overlook them while looking for the, you know, the next huge tech company or the next big Apple.
Yeah, the cool thing about what Noggin does for them is there's really a formula there, right? If you look at the brands that are doing well, they're usually doing a great job with the brand, they're doing a great job with social, and they're doing a great job with influencers. The ones that are internally focused, having to struggle with the technology, they usually are sacrificing doing those things. And those are the things that they're really good at. And so with Noggin, by kind of demystifying all the enterprise tech and allowing them to kind of go do what they're good at, it allows them to really kind of push the growth and really connect with the consumer.
Yep. Well, let's see, Jan, if we've got any final questions for you in the chat. Otherwise, I think this has been a very productive conversation. I've learned, I've enjoyed learning more about the company. I look forward to chatting with you again, hopefully sometime in the future. Anytime you guys have updates, news, you want to come on the show and talk about or break with us, we'd love to do it.
I appreciate it. I got to tell you, blue's a good color on you, man. You look good.
Oh, I like your jacket too. What is that? Nice little stylish pattern on there.
Well, you know, you said we got to go to the apparel brands occasionally, so we got to kind of shower and you know, look a little bit better.
There you go. Jan Nugent, co-founder, CEO of Noggin. Thanks again for hopping on the show today. We'll be in touch and hopefully talking again soon.
All right, cool. Take care. Thank you.
See you, Jan. All right, guys. That was Noggin, ticker NOGN. Check out that company if you want some exposure to a cool commerce as a service company. Saw some people talking about Forex in the chat, so I laid that in there. I did talk about this last week. What was my reasoning, Shelly? Weren't you in the show when I was talking about it? I showed the, oh my God. Can we get a, producers, can we get a clip of me talking about this on the show last week? And by the way, multiple times, not last Friday, I think the Friday before, when we had Tom Hayes, hedge fund tips on, he talked about how, yeah, right now, you know, the dollar's showing all this strength and realistically, it'll probably keep going up another 5-10% or so. But most professional hedgers are already hedging for that move to reverse, because here's the US dollar against the pound. Look at this on the year chart, or look at it on the 5-year chart. Anytime you have a parabolic move, I said this last week, I'll say it again. I don't care what it's in. I don't care if it's Dogecoin. I don't care if it's oil. I don't care if it's the US dollar against the pound. Anytime you have a parabolic move in the financial markets, there will be a correction. So guess what? I was fine going short the dollar, knowing, hey, this could go up another 10%, but that correction is coming. Of course, today, the news with the tax cuts in the UK, we got news today that they're reversing course on those tax cuts. The UK announced that the richest, you know, will be getting tax cuts, and the pound got weaker on that. But even without the news that they reverse course on that, if you look at the chart of the pound, it was already coming up before they announced. See, this is the month. I want to say they announced that about a week ago. Actually, sorry, it was going into last Monday. So you can see all throughout the week, the pound was moving up even before they announced it. So I don't think it's fair to say, oh, that's exactly why the pound is so strong today, is because they reversed those tax cuts. But I do think that is good for the currency. So we shall see. Went heavy UDN finally. All right, guys. Quick rundown for the rest of the show. Here in a few minutes, I will be joined by Steve Sanders from Interactive Brokers, talking about a cool new product, a thing we're going to be able to do on Interactive Brokers. I'm excited about it because, like I said, as someone who dabbles in some more how I like to call it, some more kind of degenerate investing, this is something that I absolutely love. I'm looking forward to doing. So if you guys use Interactive Brokers, or you've been on the fence and you want to check it out, you might want to after today. I believe we also we have a code or something maybe to sign up for new accounts. If not, maybe I'll get you my personal referral code if they have those. All right, let's go ahead, and because I've got Steve hanging out with me, if I get a thumbs up or something from him that he's ready to go, we'll go ahead and bring him on the show. There we go. Let's go ahead and give Steve our very special introduction and bring him on the show. All right, Mr. Steve Sanders, welcome to Benzinga Live. Thank you for taking time out of your Monday to join us. How are you doing today?
I am fine. Thank you for having me today, Aaron.
Of course. So, let's get straight to it. Well, I guess let's before we get straight to it, we'll get to it, I promise, Steve. But before we get straight to it, why don't we start with kind of a brief overview for those unfamiliar with Interactive Brokers. I know a lot of our audience, we have people from different, some might use I know these might be dirty words to you, but some may use E-Trade, some may use Robinhood. How does Interactive Brokers really differentiate from other platforms in the space?
Well, Interactive Brokers is very different from the other retail brokers. We actually got our start many years ago, going back to 1977 as an options market maker. So the tools and everything we build are more sophisticated than the other retail brokers. We were always looking for do-it-yourselfers and people that really wanted to learn. And our thought was we would provide the pipes so people can trade stock, options, futures, Forex, bonds, anywhere in the world from the same screen. So 3 competitive advantages, lowest cost, greatest breadth of product around the world, and what we consider to be the best technology. So that's kind of what differentiates us from the rest.
Yeah, and I gotta say, Steve, I don't know, I haven't checked recently, but I remember about a year or so ago, maybe a little more, back when interest rates were a little lower, I remember looking at the margin loan rates for Interactive Brokers and just how crazy low they were. Like, I was absolutely shocked by how much money you could essentially loan for free, basically, on Interactive Brokers. Is that still the case? Do you know?
Absolutely. So the way we work our interest rates, not only on the margin loans, but the amount you get paid on your idle cash balances, we basically take Fed funds and subtract 50 basis points and add 50 basis points to each. So as the rates go up, you earn more, and maybe margin loans are a little bit more, but certainly not like the rest. And as rates come down, the margin rates go down. And unfortunately, over the last few years, they went so low that we weren't paying anything out because the Fed fund rates were so low. So we will continue to be competitive both on the margin loan rate side and the interest we paid, because we just tag that to the Fed funds. Most other brokers, they make up some rate called the margin loan rate that they just keep raising, and I have no idea what it's based on. And they pay little on the idle cash balances. So come to us, and you're always guaranteed to get something that's in line with what the Fed is doing.
Yeah, and I like how how transparent you are about how these rates are kind of calculated. But yeah, I mean, looking at it right now, you can see. I remember though checking back when the federal fund rates were low, just being like, "What? You can take a $100,000 margin loan out with a 0.5% interest?" Like
it was very low. It was down. I think it was as low as 1.4% or something like that. But yes, it was dirt cheap when everybody else was charging 8, 9, 10%.
Yeah, and I gotta say too, because you might find this funny, this probably wasn't the smartest thing for me, but my mom, so like a year or so ago, was looking, probably, when the stock market was probably close to its high. She was like, I need to start investing some of my money. What should I get started? What platform should I use? And it's my mom. She's not really trying to trade, do all this stuff. She's probably not Interactive Brokers like core client or who would it be, who the platform would be best for. But it's what I use, so it's what I recommended to her, and then she got it, and people are like, what do you do? Like, just have your mom get an E-Trade or something and have her throw some money in the S&P. She doesn't need to be on Interactive Brokers and get all these million things, but now she's on it and she likes it.
Right. I'm glad to hear that. Something else about margin loans that people don't realize. I mean, and you probably wouldn't realize it if your broker was charging you 9 or 10%. But if you needed to borrow money, let's say to buy a car or something else, you can certainly take out a home equity line of credit. You can charge it on your credit card, or you can withdraw the money out of your Interactive Brokers account and borrow at the rates that you just showed, which are fairly low. And a few years ago, we added a debit card to that for convenience. So if you're out and about and you need to charge something and you have enough cash in your account, it will be taken out of the cash in your account. And if you don't have enough cash, then you can take out a loan that's essentially securitized by the equities in your account and borrow at the rates that you just showed. So it's a very cheap and effective way of borrowing this debit card or even just withdrawing the money out of the account.
So what I'm hearing, Steve, is that we're pretty close to me being able to use Interactive Brokers just for all my banking solutions. Can I get an Interactive Brokers credit card anytime soon?
Yeah, you can get a debit card any way you want, anytime you want. Unfortunately, what we've discovered, I mean, there are certainly a lot of people that use it that way, but a lot of others, you know, they kind of like to have their bucket of money for their credit card and their bank account and their broker account. So they don't like to mix everything together. If you do want to mix everything together, as I said, it's a very efficient way of doing things.
Yeah. Well, Steve, let's transition from the margin loan rates into the big news of the day. Why I've got you on the show today.
Good.
Two words. Event trader.
Yes, event contracts. So event contracts are something that are being offered by the CME. We are probably the largest broker offering them out of the CME. And the idea, and we partnered with the CME on this, is to provide an easier way to trade futures for those people. When they hear the word future, it just scares them off and they don't want any involvement in it. So the way these contracts work, they're essentially binary options in the background, okay? And what the contract works as follows. It is a yes or a no question. So let's say you're thinking about WTI oil. The question will be something like, will WTI oil be above the price of X? And you would come in. There would be a price for the yes. There would be a price for the no. Maybe the yes will cost you $10.50, and the no will cost you $9.25. And let's say you want to trade on the yes, then you will go in. You will put your the $10.50 will be removed out of your account. You can never lose more than the $10.50, and that's a very important part of this contract, that your risk is limited. And at the end of the day, because these contracts are only daily contracts, you will either be paid out $20 because the price rose above the price that was quoted in the contract, or it will be below and you'll get nothing back, and all you'll be out is your $10.50. So that essentially is how the contract works. It's being offered on a lot of different current CME contracts, things like oil and gold and other things that S&P 500 and other things that people will be interested in. And they're small, bite size for a more of a retail audience and maybe more interesting than a traditional future.
Yeah. So well, something I'm curious about, I guess like my first question is, will all these underlying markets, right, whether we take the S&P index, whether we take the NASDAQ 100 index, will the event contracts will each one essentially have like one line, and that's what it's set at, right? The example here on the site, it gives, will gold close above this, trading at 1,700? Will I have the option to then bet yes or no on will it trade above 1,500? Or is it essentially like each day there's one line or price set, and that's the one, marketable action you can take in that market that day?
No, actually, there are many strikes. The one that's initially displayed is the one that's around at the money.
Around like the 50-50, where it should be even odds on both sides.
Exactly.
But then if you want to take a more long, if you want to take a more long shot one, or maybe you want to take a safer one, you want to say, yes, I think gold is going to close above, like, I don't think gold's going to go down 3% today. So would it be possible to do a lot of high probability ones where you wouldn't maybe get as much of a return?
That's correct. And there are probably around 20 strikes. But what's interesting about these contracts, alongside the prices, it shows you the probability. And the probability is basically the price divided by $20. So when you look at the yes or the no, and you look at each of these strikes, essentially the market is telling you that there's a 50% chance that it's going to go above that, or a 90% chance, or a 10% chance. So it's a good way of thinking about probabilities.
Yeah, that's so interesting to think about. I don't know. I'm already getting tangled up in my head, because the probabilities are based on the prices of the market, but the prices of the market are based on it's like which came first.
That's essentially what all options pricing
right.
is based on, are the probability, what the market thinks is the probability. This just explicitly shows you, because it's very easy to show in a binary format.
So, Steve, I know I'm not asking for any investment advice or anything, but how would you be trading these contracts? Would you be going out there buying some of these long shots? Would you be trying to buy some of the safer ones? You strike me as a guy that might want to take some of the long shots.
No, probably not.
Okay.
No, probably not. I certainly would take a look every day and see what's in there. But it depends on what your personality is. My personality is more risk averse, so I'd probably go, for something around the money. But certainly, I would not go in there unless I have been following the news, and if it's oil, following the news around oil, or the S&P 500, at least have some idea of what's happening in the markets. I just wouldn't go in there blindly, and view this as just, well, I'll put $10 down and see what happens. I would certainly do my homework on any of these contracts.
Yeah. Do you have an idea, or do you have any anticipation of which of these offered markets will be, the most popular in terms of volume?
I never have any preconceived notions when we roll out products. I think what's important, and what's been great for Interactive Brokers, is the fact that we try lots of things. Some of the things work, some of the things don't work. I'll give you a great example. We put up this bond marketplace, which I think is the biggest digital trading marketplace for bonds in the world. We offer a huge inventory. And when interest rates were low, the demand wasn't so great. Okay, and we had built it, we put it in there, so it's not like we were going to get rid of it. But I would say over the last month, the trading volume in bonds is probably quadrupled. And that's because there's lots of volatility in interest rates, and now is the time to think about them. So, just because something doesn't work at first, or maybe it gets a slow start, you really have to give it time to work itself out. But I will tell you, there were things I thought would definitely work, and they were failures, and other things that I thought wouldn't even have a chance, and they were highly successful. So one never knows.
Okay, I like that. I mean, I would assume, I assume the S&P one should be popular, the gold one. Who knows? Like you said, though, let's not make any guesses. We'll just wait and see. So, Steve, how long have you been at Interactive Brokers for?
I have been here for 21 years. So it's been a great place. When I first got here, we had less than 10,000 accounts, and now we have over 2 million accounts, and our accounts are well diversified around the world. We get clients from over 200 countries and territories around the world, and the reason for that is our universal account makes it easy, where you can deposit your local currency, and you can be sitting in Hong Kong, and if you're interested in Google stock, you deposit your Hong Kong dollars, and you can either buy the Google stock by converting the Hong Kong dollars at the best possible rate into USD, or you can take out a margin loan against your Hong Kong dollars and buy that Google stock. So, and the same works for somebody in the US. So we just make it so easy, and that's really been the key to our growth, to find do-it-yourselfers, not just in the US, but all around the world.
Yeah, well, that's amazing, Steve. I mean, they hired you 21 years ago, had 10,000 accounts, and you personally, individually added more than 1,999,000 or 90,000 accounts. Great job.
Well, I certainly wouldn't say personally. We have a great team here of technologists and marketers and customer service people that all contributed to this. But certainly I've been very lucky to be able to be here to see this growth.
So 21 years, that brings us back to 2001, also a very interesting market environment. That means, of course, you were with Interactive through the 07, 08. Where does, and I know we're kind of sidetracking from event contracts here, but we'll get back to it. How does just this overall environment to you, does it remind you of the .com? Does it remind you of 07, 08? Where do you stand as far as just overall kind of, I guess, feeling of the markets, what's going on in the trading world?
Well, I actually ended up at Interactive Brokers right when there was the .com bust, and that's one of the reasons I'm here. I was with Citigroup for 15 years before that, and Thomas Petterfee, who's our founder, offered me a job here. But certainly, I've seen the .com bust. I've seen what happened in 2007 and 2008. I've seen the 1988 crash. I've seen a lot of them, and the only advice I have to anybody is that things eventually turn around in either direction, and equities over the long term have always gone up, and people need to stay the course and not panic, and manage their risk, and not take too much risk on at any point along the way.
Yeah, and I think that's what we're seeing a lot now. I think, whether you're looking at individual companies or
Right.
fund managers, the ones that are in trouble are the ones that took on a lot of risk, and that's why it's called risk, right? There's always
Right.
going to be a downside associated with trying to leverage growth. So yeah, I don't know. I mean, I right now I'm just sure it's been an interesting time. Of course, COVID too. I mean, you probably saw a huge influx of accounts or interests in investing during COVID. I know we did.
Yeah, COVID, we did see a lot of accounts coming in, people, that maybe they were bored or needed something else to do. but we certainly saw a huge pickup during COVID. And it really hasn't, subsided that much. I think there's just more of a general interest in trading the markets, not only in the U.S., but around the world. So although we're not seeing the huge volumes that you might have seen with the meme stock craze and in the middle of COVID, it's still been pretty robust as compared to the years right before what happened with COVID.
Yeah, and I mean, that's what's interesting is even before COVID and the markets really took off from there, if you looked at something like, options volume, like options trading has been on a stark uptick even into COVID. Before COVID hit, we were at like the most options contracts ever being traded, and then the COVID kind of just exacerbated that. Do you expect that trend to continue? It seems like to me, just among retail traders, like there's been a huge interest increase in options as opposed to just regular stock picking.
Well, stocks and options, especially options, the volumes come when there's volatility. So, I've seen it here in Interactive Brokers, at Citibank when I worked there. For a number of years, we had very low volatility and nothing was going anywhere and things were trading sideways. So certainly there's a lot less interest when things are trading sideways. Lots of excitement when the markets are going up and lots of trading. And there's also lots of trading going on when the markets are going down, as long as there's some kind of volatility and an opportunity to make money.
Yep. Well, let's see. I'm checking up on the chat, Steve, to see if we've got any more questions about the event contracts. Is there anything regarding the event contracts we need to touch on that we haven't yet?
No, I think we covered it all. The main point is that this is a new form option, a binary option that hasn't really been offered out to the public. Certainly the banks have had them for a number of years. But it'll be interesting to see, what types of, events that the regulators will offer on these contracts in the future, because essentially, you can think of lots of different types of events that you might utilize an event contract for, and it's just all up to the regulators what they will approve going forward.
Yeah, I'm excited about it because I like to dabble, whether it's me buying some, SPY option contracts that expire the next day. I like to dabble in some of these things, of course, and I always tell my audience, right, I have my long-term investment account, right? My Roth 401k, my more legitimate investment accounts, and that's, it's a lot safer. But then if I have a couple $100 and I want to, buy some SPY option contracts, knowing full well that it's very likely, in fact, potentially even more likely or not that goes to zero, I'm willing to do that sometimes. So I like, having this opportunity to do it in a very binary, clean, easy way.
That's exactly right. I mean, if I didn't have this full-time job, and maybe someday, I would think about life in the same way. I would have my investments that are for retirement, and then I'd have a little bit of play money where I can, take a little more risk and, really shoot for the stars. So certainly we're in agreement.
Well, when you're ready, let me know. I want you to come to me and we can do it together. We can
do it together. Absolutely.
We can make some fun YOLO bets on some, options, but not yet. We'll wait.
Okay.
All right, Steve. Well, thank you for hopping on the show today. I'm gonna get that link in the chat for folks to go head over to Interactive Brokers if they're not on there already. It's a pleasure having you on the show. I hope we get to do it again sometime.
Absolutely. Thank you for having me today.
Of course. Steve, enjoy the rest of your Monday and have a great week.
You too. Take care. Bye-bye.
Bye-bye. Aaron Bryan saying Steve seems strangely familiar. I kind of agree. I feel like, I don't think I've ever spoken to Steve before, but I feel like I kind of have. I think he's just a nice, friendly, personal guy that I wouldn't mind going to grab a lunch or a beer with. Yeah, support our boy AB. Smash the like, please. I don't get to eat lunch unless this stream gets up to about I think what they say, Aaron? 75 likes today for me to get lunch. 1,000. You said 1,000. All right. Well, I might be hungry for a while. So can you guys please go ahead, smash the like. How many? 100 likes. Aaron Thomas says I can eat for. We got 200 people watching. If we have 200 people watching, we need 100 likes. My quick math. My quick math tells me we need only 50%. Only 1 out of every 2 of you. But if everyone has that mindset that we only need 1 every 2. If you reach 75, you can go take that back. Wait, what did you mean then, Aaron Brian? That he seems strangely familiar. I don't know. I don't know what you were implying there. If you hit 75 likes, you can go hit that bathroom break. How do I get? Oh, there we go. All right, Steve's off the screen. All right, guys, we had 2 great guests on, from Jan and Steve from Interactive Brokers. Noggin, 2 public companies. I don't even remember the last time we had 2 public companies on the show in the same day. But now we've got about 30 minutes of us to just hang out, talk about the top news of the day, talk about trade ideas. Again, we can dabble more into Forex. I personally, the reason I haven't been talking about the Forex markets much on the show is just because I've personally been kind of getting like more into it. So I don't feel like I have a really good understanding. I'm not saying I'm an expert on the, anything really, but certainly not Forex. So I don't want to, say anything that makes me sound silly or whatever. But again, Tom Hayes was on the show a few weeks ago, talked about that move, just saying, hey, look, you see this parabolic move of the dollar. The dollar can't go up forever against everything, right? It's got to normalize at some point. Not surprised to see the pound starting to come back. And my whole thing right now, to be honest with you, and I talked about this on the show too, that the bear case has been shifting. If you guys have noticed that the people that are the most bearish, whether you're looking at your Michael Burries or whatever, they're talking about different things every other week now, right? A month ago, it was all about energy prices in Europe and that England and Germany might not make it through the winter and something was going to break. And we've seen energy prices fallen in Europe, and the futures markets, the futures markets for baseload power in Germany and England showing that the expectation is for those prices to essentially be back normalized by the end of the year. And you don't hear those same people talking about it as much. You don't hear them saying, oh, actually that thing I was talking about, the energy crisis in Europe, is looking a lot better now. And same thing kind of with gas prices and inflation here. But I think the Europe fears overall are overblown right now. I'm not saying there aren't things that aren't problematic that could potentially happen in Europe. If I had to guess, if something were to break, if there were to be some big financial crisis in Europe versus the US, I'd say it's more likely to happen in Europe. Okay, see that I don't know, like the energy prices in Europe, right, are higher than normal. Like we've had a supply crunch around the world, but from what I've seen, these things have been getting better, but EU don't have enough all right, again, this is my opinion. I'm not saying it's a fact. My opinion is that these fears, specifically about the European energy market, but more overall, are overblown. And I could be wrong, but when I see tweets and stuff of people talking about how businesses are going to need to close in Europe because I just don't, you hear about this all the time. U.S. coal prices hit 200 at highest ever. Yeah, what's more likely scenario, right? That Europe's not going to have enough natural gas or renewable or because of Russia, and so they're all going to freeze and have this, or we start exporting more coal. I think people underestimate how much resources we really have available, not just here in the U.S. but around the world, right? Hey, if Europe needs it, we can get them some coal and some natty gas, and they'll be able to make it through the winter. If you think I'm wrong, You think the winter is going to be this huge catastrophic event in Europe. And after, I don't know, when the last time there was a winter like that where people didn't have heat or power in Europe, you probably have to go back to World War II. If you think this is the first year in 80 years, right, that people's homes are going to be freezing and people are going to be freezing to death, then sure, go short Europe, go short the stock market. Sure, I'm saying I don't think that's going to happen. I think come December, we're going to be celebrating Christmas and people in Europe are going to be fine. They might be paying a little bit higher on the energy bill, but those prices have already started to come down. Trends are showing that they're supposed to keep coming down. So to me, it's not, it's almost as if people are rooting for a big catastrophic event and people to be in trouble. I'd rather be on the other side. I'd rather be looking at this and saying, hey, we've drawn down a lot already. Is it more likely that, you know, things are going to be okay and we revert back to the normal, or is it likely, because that's what you're doing as an investor, you're basically investing in what you consider likely. Is it likely, do you think Tesla is going to keep growing and go up from here? If you think yes, then go out and buy the stock. If you think it's likely that you know, that there's going to be some big catastrophic event, winter's going to be this terrible, you know, thing, then yeah, of course you should be a bear. I'm saying I'm not super bearish right now because I don't think that's the case. I haven't seen anything that shows me that that's going to be the case. In case I've seen the opposite. I pulled it up on the show last week. I'll pull it up again. Let me find it real quick. The European energy prices right here. Again, this was like the biggest bear case about Europe. And it still is, according to some people in the chat. Look, here where we were in August for Netherlands, natural gas forward 1 month mid price. Above 300, down to 173 here. France baseload power forward 1 month. So sure, this was, granted, it was fair to be kind of freaking out about it right here. But just like I was talking about with the dollar, anytime you see parabolic moves like this, like from the baseload power in France going from 200 to 800 in the span of 3 months, it's going to normalize. So if this trend continues, and I don't know if we've got any technical, you know, chartists in the chat, if this chart continues, if the futures prices for power in France, in the UK, in Netherlands, wherever you're looking, Germany, continues to fall, then explain to me how we are going to have this catastrophic energy crisis, right? Or is the U.S. not going to step in and supplement with coal or more natural gas to help offset the problems that have arisen from Russia not being able to get as much oil to Europe? Of course. What's the alternative? Of course, Europe is going to be able to make it through the winter. If not on their own, then with some help. Yeah, thank you, James. Like, again, I could be wrong, and it'd be breaking a precedent of 80 plus years, whatever. Super Bear. Is that like Superman but with hairier claws? Dude, I'm not saying it's a black and white thing. I'm not saying it's either going to be a catastrophic event or be fine. I'm saying right now, the main thing driving, I think, a lot of bear case is this energy market, or at least has been in Europe. If you start digging into it, it's the same thing as the Credit Suisse thing. It's like it sounded really bad, and then you start digging into it, and it's not as bad as the situation sounded a lot worse. And that's how I basically see the European energy thing. The way people were talking about it made it sound a lot worse than when you start looking into it than it really looks to be. It looks to be, yeah, it's a problem. It's going to be a little bit more expensive, and the winter might be tough, but things will probably be okay. Not, oh my God, you know, businesses are going to have to shut down in England because they don't have power in the year 2022 and all this. Again, I don't have a crystal ball. I could be wrong. Enoch Lyons saying, what do you think of the Kardashian news? So if you guys missed this, Kim Kardashian settled, I believe, settled out of court for $1.2 million because she promoted a cryptocurrency that she did not, I guess, disclose that she was being paid to promote it. Let's go ahead and pull this up on Benzinga. shout out Martuza, who got this article out. So Kim Kardashian has been charged by the SEC for promoting a crypto asset security issued and sold by the Ethereum Max on social media without reporting the compensation she received for the promotion. Kardashian agreed to settle the case by paying $1.26 million in fine. Yeah, so she basically settled out of court, which means she probably was, the initial lawsuit was probably for a little bit more than that, but she decided to settle out. Here's a picture of the ad. Are you guys into crypto? This is not financial advice, but sharing what my friends just told me about Ethereum Max token a few minutes ago. Ethereum Max burned 400 trillion tokens, nearly 50% of their admin wallet, giving back to the entire Emax community. So, well, hold on. She's got right here, hashtag ad. The federal securities laws are clear that any celebrity or individual who promotes a crypto asset must disclose the nature, source, and amount of compensation. Okay, so it looks like she at least in her defense, gave the hashtag ad. But I guess she was supposed to say exactly how much she, was paid to do it. You never see. You think Matt Damon is coming out and saying how much he got paid for Crypto.com to do those Fortune favors the brave commercials? I mean, shit, Larry David was in a commercial too. And here's what I'll say is the whole time I was kind of critical of these different projects being shilled or whatnot. There's a reason these people that were paid to promote these things took the money they were being paid to promote these crypto assets. Not every time, but a lot of the times. And I think with these major celebrities, especially like Larry David and stuff, they were getting paid in US dollar, right? Kim Kardashian wasn't like, oh yeah, here, I'll post this Ethereum Max ad for some Ethereum Max. No, she was posting it for US dollars. So they're taking a different currency to shill you this one when they're not even wanting to touch that one themselves. And by the way, the same thing was happening with NFTs and NFT artists. It was like, why are, supposedly, like, why are people and stuff, these NFT artists getting paid so much US dollars to create these things? Wouldn't you think they would get it? Yeah, I mean, to be fair, do you really think that's prison worthy? Her promoting Ethereum Max. How is that different, right? I mean, I get it. You probably have some more responsibility as a celebrity, especially Kim Kardashian with millions and millions of followers, probably a lot of young, impressionable people. But I don't see that any differently than someone who owned Bitcoin, shilling Bitcoin, going out and saying, hey, this is the best currency ever. The US dollar's worthless. Like, I think that's where I got really turned off by a lot of different crypto projects is when you hear people basically start to essentially just get really hyperbolic, get really exaggerating when they're trying to sell it. It becomes not it turns me off more than I'm being sold to it. So if you want to tell me like Bitcoin has some good technology, it could be a decent way to potentially make some money with all these, sure. But if you're going to tell me that the US dollar is worthless and you need to own Bitcoin for this and that, then you're going to kind of lose me. Why isn't Ben getting fined? Who's Ben? Ben Affleck? Did Ben Affleck do a crypto thing too? Again, I don't. I think a lot of people will see this, hopefully celebrities, and then maybe think twice next time they try to shill a crypto and be like, do I want to be on the hook for a $1 million fine? Probably not. Oh, Ben Armstrong, the Bit Boy. We've had him on the show before, actually. I don't know. But that's just kind of his whole job, isn't it? Right? To like promote Bitcoin and be like a Bitcoin promoter. I saw a video on Twitter of someone going after him because he tried to claim, oh, I called the bear market. And then someone posted a video of like, hey, here's you shilling it at literally like the top. Yeah, I don't know. I mean, I don't, it'll probably, trust me, it'll be a very hairy situation if they start trying to litigate and go after every single person who, you know, has ever said anything good about crypto. I think here with the Kim Kardashian, what made the case bad was she wasn't fully transparent, I guess. Again, I personally, like, I would have figured just with that hashtag ad, she got all her bases covered, because then people know, hey, this isn't some legitimate, you know, coming straight from Kim Kardashian for real. It's an ad. Who cares if you know how much she was paid to do it or the nature of the relation? An ad's an ad. At the end of the day, an ad, you know, is an ad, and you should transparent. You should disclose it. And with that said, on that note, full transparency here, we are partnered with at least to some degree. Not that either the guests we had today from Interactive or Noggin were paid for appearances. They weren't, but we do have business relationships with both companies. I think it's important to be transparent about that as well. Other big news on the day. We said we were going to talk about the Credit Suisse situation. Look, guys, one thing that I really like about the stock market and financial markets, they're not objective at all, right? Well, I don't know. Like, the prices are objective, right? Not subjective. But you can oh, wow. All right, luckily these aren't my Google searches that popped up. I was worried they were. These are just trending ones. Aaron Rodgers hairstyle is the first one. Wow, Albuquerque Balloon Fiesta, number 3. Did not have that on my bingo card for the day. If you had that on your bingo card for the day, congrats. You probably would have made some money on some event trader contracts and Interactive Brokers if you had Albuquerque Balloon Fiesta being the third most searched. Well, I don't know if it's the third most searched, but it's trending. One thing I like about the stock market I was getting to, you don't need to, like, I can basically say, I read a lot about the Credit Suisse situation, you know, over the weekend, because if you follow Twitter and you followed only Twitter, at least if you followed my Twitter feed, you would have thought Credit Suisse was bankrupt today, and you would have thought, you know, you got those same pictures of the Lehman Brothers or Bear Stearns people bringing their boxes out of the office, whatever. You read about the situation a little more. It's kind of like the European energy situation. I see it. Yeah. It sounds bad, and there's probably some problems there, some underlying problems that are serious and need to be addressed. But is it, you know, this huge thing? I don't know. But what I like about the market is I can just check the stock and see that the stock's green today to know that for a fact, or I'm going to say it, probably isn't really for a fact, but I can say with the stock being green today, it's pretty clear a lot of these fears were a little bit overblown. So, you know, Citi says Credit Suisse stock is a buy for the brave. I'm not going that far. I'm not going that far to say it's a buy. I'm just saying, you know, do we think, does anyone have a live chart of like the credit default swaps? I'd be curious if those have come down at all. So if you are, why people care about credit default swaps. So apparently what credit default swaps are, they way for investors to hedge risk in investments they have. Say I have my whole entire life. Oh, whoa, I didn't mean to do that. Say I have my whole entire life savings into Apple stock. You can buy credit default swaps on Apple so that if Apple defaults on their credit, if they go completely bankrupt, you actually make money. So one of the ways Michael Burry, or I think the main way he made a lot of money in the 2008 housing crisis, was buying credit default swaps on these different lenders that he knew were eventually going to go bankrupt. You're essentially betting on the downfall, the bankruptcy of a company. So the credit default swap markets, like I was saying, how I like to check the stock, see the stock market usually puts things into good perspective for me. Those were saying shit was getting ready to hit the fan, right? A lot of people hedging their investments seemingly into Credit Suisse. The credit defaults were trading at their highest price since 2008, I want to believe. But let's go through one of these news stories that came out today that gave probably a little bit more light on the situation. I don't know, you know, how much of this So here, let's go through here. Let's go to Bloomby. Bloomby, I think I read this Bloomby article that did a decent job describing it, I think. So Credit Suisse whipsaws as CEO memo backfires. Analyst back bank shares briefly eke out gains after a 12% drop. Market turmoil came after CEO attempted to reassure markets. Credit Suisse briefly turned positive in a wild trade and saw a drop as much as 12%. Stock recovered late Monday after several analysts published notes bolstering bank executives' arguments that the firm has ample capital and liquidity to weather the current uncertainty and market volatility. So right here, I mean, I'm not going to say, oh, everything's fine and dandy at Credit Suisse. I don't think that's true. I think them and Deutsche Bank are probably two that are closer to being on the brink than other investment banks. Maybe they took on too much leverage. Maybe like SoftBank, they're just very high growth oriented. I'm not quite sure. There is a slight chance, I would say, you know, these analysts or whatever that are bolstering bank executives' arguments, whatever. There probably is some degree of like, oh shit, you know, we can. This whole thing is potentially like coming to an 08 crisis. We got to try to you know, limit some fear out there and just say everything's okay. There's a chance of that. I don't think that's true. I think if it were a really dire situation, but anyway. Let's see. The turmoil was sparked by a memo late that day from Chief Executive Officer Erlich Korner, in which he had sought to play down speculation surrounding the bank's overhaul plans, which it expects to announce on October 27th. While arguing that the bank's capital levels and liquidity are strong, he acknowledged the bank is at a critical moment. So again, like Shelly said in the chat earlier, not black and white. I'm not saying it's either Credit Suisse fine or Credit Suisse bankrupt. It can be somewhere in the middle. But I think, at least from what we were seeing, like speculation on Twitter and whatnot, a little bit maybe more bark than bite, as we can put it. That there might have been some more kind of fear baked into headlines than what. Yeah, and I mean, we'll see. We shall see. Other big news on the day. Man, oh man. Oh, to be short Tesla today. Wish I was holding some puts today. Let's go ahead and get into my Benzinga Pro. Apple. Woo! Up to, before we go over to Tesla, let's check in on the S&P. S&P giving up some gains. QQQ's up a little bit. Tesla. Wow. Oh my God. Oh my God. Why is this happening to me? Taking a screenshot of this, sending it to my team, saying what the hell is going on. All right. Back to Google Charts we go. Tesla down 8.75% today on news that deliveries came in lower than expected. I don't even know. Maybe some big Tesla investor, someone who's been following the stock a while. Can someone let me know in the chat when the last time Tesla missed on deliveries was? I thought they were always wait. Bolsonaro's possible win? I'm so confused. I thought I saw he lost last night. Is this fake news? The second round will take place on October 30th. But is this fake news that Louise Lula or whatever got 48% of the vote? First time ever, U.S. coal above 200. Woo! Let's go ahead and check BTU, Peabody Energy. How is this a possible win, Shelly? Very confused. Is it because he might do a coup? He seems like the type of dude that would do a coup. Easy Mike saying, Bolsonaro has a chance. Oh, someone needs to win 50%. Got it. Wow, how does that make sense for an election? That you need 50, right? Like if someone gets 48 versus 43, you would think. But anyway, second round will take place on October 30th. I actually think, I think, I mean, that's a decent lead. It looks like Bolsonaro has. I feel, or Silva has. Like, if you really think Bolsonaro has a great chance, you have a great opportunity to buy him at 22 cents on the dollar here. This is Predicted, which is similar to kind of those event contracts, a little bit different. But if you think Bolsonaro's got a great chance, then 22 cents on the dollar is a very good discount. You can see the market's up 4 cents today. I think it's kind of like buying a stock that's been bought out. That's, you got that little arbitration there, where if you buy a stock like Activision, where the price target's supposed to be, or 15 or 20% more, I mean, in this market environment, if you can get what looks like a pretty sure thing in Luis Lula da Silva at 82 cents on the dollar, that goes up to $1, you make, close to I don't know, what is that, 20% on it. I might do that. I might throw a couple $100 in this, because going back to the Google, like, this isn't, it's not really, you would say, neck and neck. And here's what I'll do. I'll do some more research into this, because depending on what party Simone Tibetan is, what the MDB is, if she's more conservative, then you could argue that it's likely Bolsonaro picks up a lot of her votes. If she's more progressive, then you could argue Lula will pick up some of her votes. So, yeah, I mean, we'll definitely check back in on that, because I think, again, those predicted markets are interesting at a time like this. I don't think that's a gamble. I don't think buying Bolsonaro when he's got a 5% lead in the polls a month before the second round of the election is really a gamble. I think that's a smart investment decision, personally. What were we talking about before we were going to go to... Oh, we were going to talk about coal. We're going to talk about BTU stock. Let's check that out. Let's just search butt stock. Yeah, I think BTU, right? So here's the thing. You have to, when you're looking at like the valuate or the fundamentals, a lot of these energy companies, you got to keep in mind kind of these like multiples, like Peabody Energy's PE listed at 5 here on Google Finance, probably really cheap compared to its financials the past like 4 quarters. But Peabody, with coal being more expensive than it's ever been, Peabody's been putting out some great quarters. So for it to be this cheap as a stock, it essentially needs to keep putting out quarters like that. I think there's a market expectation that maybe not this year, maybe not next year, maybe the year after that, eventually, right, coal prices will come back down and demand will continue to kind of dwindle of coal overall, as it's been doing, right? Demand for coal-powered energy over time, it's more likely than not it's going to continue to dwindle. Of course, right now, the complete opposite. You've got a Russia-Ukraine war that's causing a supply-side crisis in energy around the world, making coal more valuable, because it's something that we can use to step in and say, oh, Europe's going to have a lot less oil from Russia this year. All right, let's send them some coal. I hope you guys still got your infrastructure to run coal power like you had probably 30 years ago, but you're going to need some of it this winter. So coal's having a great time. I don't know how interesting BTU is as a stock unless you think for a while coal is going to remain to be kind of a substitute for other energy sources, and that energy in general is going to remain the supply is going to remain limited. I mean, shit, we just got a headline today that OPEC is gonna cut production to prop up the price of oil. Because if you get a real global recession, prices of oil are gonna tumble across the board. So they're gonna do what they can to try to prop up those prices, cut production. I think that's good for coal. I honestly don't really know any other good coal plays. How about this? If someone wants a homework assignment tonight, what about like a coal transportation company? Like I know that the LNG transportations, what's the one? It's like FLNG stock. Is that the Flex NG? Yeah, FLNG. It transports. I think they own the freight, the shippers, the boats essentially bringing the LNG, the liquefied natural gas, from the U.S. to Europe. That stock's probably going to do well for a while. But if we found a coal transportation, yeah, let's find a nice cold play. I like that. I'm over these pops. Sell the rips. I'll tell you, I don't disagree with if you were long today, taking some profits, whatever. I wouldn't want to go short in this environment. I've been saying that. It just doesn't make sense to me. Like, the market is where the S&P 500 is where we're at, knowing all the things we know, right? About the energy situation in Europe, about inflation in the US, about the Russia and Ukraine war. To me, to take another next leg down, we're going to need a catalyst. Could be earnings season coming up for sure. A lot of people are anticipating that. But to me, I haven't seen a compelling argument for why the S&P 500, for why the overall markets is going to take a next leg down. My opinion is opposite from Triple D. Probably not a great side to be on, but hey, a blind squirrel finds a nut twice a day. All right. It's 1 p.m. You know what that means. Time to wrap up Benzinga Live. This stream will automatically redirect you to stock market movers with Money Mitch. Money Mitch is bringing on Luke Lloyd, the wealth advisor investment strategist at Strategic Wealth Partners. And then he will also be talking to, looks like that's it today. Luke Lloyd, the man with two first names and better analysts of financial markets. Smash the like, everybody. You have to look at both ways. MU, horrible guide, didn't go down. Exactly. Once you start seeing, stocks either going up or not going down on terrible news, that's a sign to you. That should perk your ears up and say, oh my God, this company guided down. And that's exactly what I'm talking about, is that I think a lot of this is priced in. So I think when you get a lot of companies that give some not so great earnings reports, it's going to be like, oh yeah, we expected that. Actually, that was bad, but it wasn't as worse as we expected. Next thing you know, the stock's up because they missed. It's the exact same thing that when we were at the market top and you had companies reporting great quarters and their stock were down. So I agree, Jay Rice. You got to look at things like that and pay attention to, because those can be huge telling signs. That can be really loud, and we'll again see it on an individual basis for different stocks, like you're mentioning MU. But you can look at it overall too. So if we get a day where we get some big headline where it seems like the market should be down a lot, but it's not, you got to pay attention to that. Price already built in. Exactly. Couldn't agree more. All right, guys. I got to run before Mitch gets mad at me. Love you guys. We'll be back tomorrow. Till then, stay green. Smash the like for me. We'll be back soon.